We're going to be talking about mobile home park investing and the top 3 mobile home park investing mistakes to avoid. I'm going to repeat that because we are live, and we are going to be talking today about mobile home park investing mistakes, the top 3 that you need to make sure that you're avoiding when you're buying mobile home parks. Super excited to have you guys on. We're going to go live, and I'm going to be able to answer your questions as well here towards the end. So make sure to stick around. I promise you I'm going to give some really good value for those of you who are looking to invest in mobile home parks, currently investing in mobile home parks, or you're in real estate investments and you want to take your game to the next level. A lot of what I talk about here is going to be very, very relevant to you, regardless of the property type. So make sure to stick around, and most importantly, drop in the chat in the comments if you've got questions. If you're on Facebook, make sure that you follow the instructions at the top of the video where it has the description and everything, because there is one step that you need to actually follow if you're on Facebook, so that I can see your chats coming in real time right on my computer. All right, so let's jump into this. First of all, if you want to invest in mobile home parks and you're really serious about it and you're like ready to get going and get that first deal done in the next quarter, do yourself a favor, shoot me a DM with the word learn, and I'll get you some information on my coaching and course program where I'm helping other investors go out and buy their first mobile home parks, operate them. It's super thorough. And it's everything that you're going to need in order to go out and make it happen. You can either DM me the word learn or go to getrealcashflow.com. Again, that's getrealcashflow.com. And awesome, we're having people already chiming in on the chat. So make sure you drop your questions in. I will be answering them throughout the discussion. We're going to have a lot of fun here. I'm going to make sure that we get you guys tons of value. So let's talk a little bit about mobile home park investing. Sweet, they're all coming in. Keep them coming, guys. Keep the questions coming. I'll make sure to get to them. It's really important that whenever you're investing in anything, whether it's stocks, bonds, funds, whatever, real estate, crypto, whatever it is that you're looking to invest in, that you get educated, that you understand what you're doing. I promise you one thing: there is no way that you are going to go out and buy multi-million-dollar investments and be successful at it surfing YouTube and Instagram Reels, trying to collect all this information to learn. What I'm doing here tonight is giving you the information that gets you thinking about different aspects of buying communities, but you've got to really study up and you got to work with people who are already doing it. Now, let's talk about these mistakes. Now, these mistakes are really things that have come across my desk tons of times, as recently as coaching calls that I've been doing with my students recently, and also things that I've seen in the Facebook group. If you're not in the Facebook group and you want to invest in mobile home parks, you need to jump on it. It's Mobile Home Park Investing for Cash Flow. Check that out on Facebook groups, and let's talk about this here. So one of the mistakes that I see a lot of investors making is all 3 of these are really all around evaluation, how they're evaluating and analyzing these deals going in. And it's going to happen if you haven't studied up and you haven't gotten proper education. The first mistake that I'm seeing a lot of people make is they're using the seller's numbers, right? And this actually came up on a coaching call recently where someone said, how do I determine what I should be paying for this thing, because the seller's numbers are very different than the expense ratio that you're talking about. And so what's really important here is that whenever you're looking at a deal, you're getting a rent roll and a profit and loss from the sellers, but the seller's profit and loss is really just a guide. Okay, it's going to give you some key metrics that you need to use in your underwriting and modeling out the deal, but you are not going to necessarily use their numbers in your pro forma. All right, let me give you an example. A lot of times sellers will have they'll be missing things. Okay, they will miss their property insurance, and you go, well, why wouldn't they put their property insurance on their profit and loss or in their financials? Well, a lot of times mom and pop owners, what they do is they bundle together all of their insurance across a bunch of properties, and then they just pay for it out of their personal or other accounts. Sometimes they'll even use their personal bank account for all of their properties. And so whatever makes it to those financial reports are often pretty limited. So the most common things that I see missing from the financials that I get from sellers are property insurance, payroll. And why would they be missing payroll? Well, it's because a lot of times the owners are the managers, right? So they self-manage their property literally on site. And so they're not paying anybody to manage their property. It's a luxury that you're not going to have if you're buying multiple of these parks, or even if you're buying one, you're probably not going to be the manager. All right. So they leave off the payroll. They also leave off the accounting costs. Why? Because they're probably their own bookkeeper. But chances are you're not going to be the bookkeeper for each one of your properties. So you're going to have accounting costs. You're also going to have tax return prep costs. A lot of times they'll leave off the office and the office expenses. Why would they leave off the office expenses? Well, it's because they're doing it from their home office, and all the paper from the printer, all the ink, all the shipping costs, they're just paying for it out of pocket. And so they're losing track of a lot of these expenses. Those are real expenses that you're going to incur. So how do you solve this? Well, it's really important that you take what the seller gives you and that you have a really good idea of what those expenses are when you're running it in a professional way. There's really only a few expenses from the seller's P&L that I'm looking for when I'm underwriting a deal or modeling out a deal. And one of those is going to be the utilities, okay? You want to make sure that you're capturing all those utility costs, because those are real costs that you're going to have, and it's not going to differ between them and you unless they have leaks or other things. So you want to get the utility bills from them, and then you want to go verify that at the utility companies to make sure that you've got a full year's worth of utilities. A lot of times people make the mistake of they've got a utility bill for water for 1 month and they annualize that. Okay, or an electric bill, and they annualize that, and they expect the whole year to be the same. But we all know that our electric bill is different in January than it is in July. Depending on what state you're in, it might be much higher or much lower, depending on the type of utilities you're using. So it's really important to take the seller's financials, use some key expenses in there, and measure that income compared to what they're telling you they're making, and just use it as a gauge. But ultimately, you're going to create your business plan, and then you're going to create your model based on what you know your expenses are going to be, okay? And then you're going to model those forward. So do not just take the seller's numbers and apply a cap rate to that and go pay that. What some people will do is they will use seller financing. They'll get the seller to finance it, but the problem with that is that means you also don't have a second set of eyes on those books and on those numbers, which is scary because banks will usually catch a lot of mistakes that, unsophisticated investors won't. But if the seller's the one financing you and you're just bringing money to the table and there's nobody else looking at it, you could be overpaying significantly. And you may have a lot of problems after that. So don't use the seller's numbers, and verify everything. That's my first big mistake that a lot of investors are making. Secondly, park-owned home rent. All right, you guys hear me preach about this a lot. What you need to do is you need to make sure that when you're buying a mobile home park that has park-owned homes that generate rental income, that you're not valuing the cash flow from that home the same way that you would value the cash flow that comes from the lot rent. All right. Let me give you an example. And keep the questions coming. I see them coming in, so just make sure you're sending them in, and I will get to them here towards the end. You might also want to just drop your name at the end of that comment, because unless if you're on Facebook and you didn't follow the instructions above, it's not telling me your name. So if you ask a question, put your name in there so I at least know who I'm addressing. I'll be getting to those questions shortly, so keep them coming. So let's say you're buying a park and a portion or all of those homes are rented. A portion of all those homes are actually park-owned rental homes. So they're not only collecting the lot rent, but they're also collecting home rent. You need to split what is coming in as lot rent and what is coming in as home rent, and make sure that you're valuing the lot rent based on a cap rate. We're not going to get into details on how to calculate a cap rate on this just for time reasons, but you're going to value the cash flow from the lot rent, and then you're going to separate out the home value. And the way that you're going to do that is you're going to put a shell value to it, meaning what could you take that home and get it cleaned out and sell it for, and then subtract out all of the expenses like reno costs, sales costs, title transfer fees, all that. You're going to subtract out all of your costs, and that's what you're going to pay. You got to take into consideration all of those expenses and really a blowout price. You typically, when I'm offering on a community and it comes with mobile homes, I don't put any value on those mobile homes. Unless the seller comes to me and says, you know what, I think these are really valuable homes and they've got some value. A lot of times newer homes in communities, the sellers will want something for that. But other than that, I'm trying to pay zero for the home, and I'm only paying based on the lot rent that is produced. Why is this important? Well, it's a big difference in numbers. So let's say you've got a 1980s home, and that home produces, let's say your lot rent is $400 and the home rent is $500. So they're getting $900 in rent coming in, and you apply a 50% expense ratio, or I should say a 40% expense ratio to that. I should have used easier numbers, but let's just say it's a total of $1,000. Okay, 400 is 500 is lot rent, 500 is home rent. Make my life easy. It's been a long day. So on $1,000, you might say, well, typically a mobile home park has 40% expense ratio, right? So therefore, $600 of that is capped as rental income and goes to your bottom line, to your net operating income. That's what you get to keep before your mortgage. Well, if you applied a 10% cap rate to that, then, and you had let's just say you had 100 homes times 600 a month, okay, times 12, that's a pretty big number. Okay, and I'm just going to calculate it. I should be able to do this in my head, but it's been a long day. Actually, the wife is out. I'm a big bottled root beer fan, and so don't tell her, but I'm drinking the sugar drinks tonight. All right, let's do the math here. Let's take 100 lots times $600 in what we think is your net operating income. That's $60,000 a month times 12. That's $720,000 a year. Okay. Well, if you take that on a cap rate of 10%, that's $7.2 million. Okay. Big numbers. But in reality, the bank and the appraiser and any sophisticated investor is going to look at that and say, whoa, 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 your lot rent is only $500, your home is $500, because based on market lot rents, that's what they're going for. And if you were to sell off the homes, that's what you'd be getting for lot rent. So if you take those same numbers, take 500 times 100 times 0.6, giving you 40% expense ratio, that's a $30,000 a month times 12. Divide that by 0.1, and you've got a $3.6 million value, which I could have just done that by cutting it in half, but you get the point. By making that major mistake, and that's on a big scale, you could be paying more than double for the property than what you should be. And if it's seller financed, you may make the mistake and own it, and then you can't get out of it. Okay, so it's just really important to value your mobile home parks by breaking out the lot rent and the home rent separately. And I just saved you multi-million-dollar mistake right there. Lastly, the number 3 big mistake that I'm seeing people making is location. Had a great call with somebody yesterday. They brought me a deal. They're like, hey, you want to partner on this? And so I started looking at it with them, and I'm like, boom, size is good. Rents are okay. They're not super high, but they're reasonable. The utilities are good, city water and sewer. All these different check boxes are getting checked. And I'm like, sweet, we've got a deal here. And so after we kind of ran through the scenario of what was going on with the property, the first thing I do is I always check the market, right? So I check the market. I look at some specific data points that are important to me. And I realize very quickly that the median home or medium, my tongue's tied, median household value, home value is about, I think it was 75,000. Okay. And then the median home income was like 30,000. These are really low metrics that instantly tell me that this neighborhood is not good. It's telling me that this neighborhood is going to be very low income and it's not going to be a very stable property to own, especially as a lot rent community. And what a lot of people are doing is they're in a rush to get into deals and they overlook the market, the specific data that tells us how much money people make that live in that neighborhood. That's really important because that's going to tell you what they can afford to pay in rent. That's going to tell you what your competition is for single family homes. Like, give you an example. If you're bringing in a new mobile home to fill in an empty lot, and that new mobile home has got to go for, let's say, $70,000, but you can go buy a single family stick built home with land for 75. You're going to have a really hard time marketing those homes. They have a really hard time filling lots, and what ends up happening is those homes end up having to become rental homes because the only people that are interested in living in your community or that live in that area are just renter mentality people. And so for apartments, renters are great, right? But for our communities, we want homeowner mentality people. So it's really important to understand the neighborhood that you're buying in. And I can't tell you how many times I've personally made this mistake where I got excited about a deal. Started doing all this math, started running all these numbers, doing all this research, but I forgot to check the market, right? I forgot to check the neighborhood data, and I spend all this time on it. I maybe even make an offer on it. And then I either show up or I go and actually remember to research that stuff, and I go, oh, crap. This park is in the hood, and it's in a really rough neighborhood. Well, the problem with that is now I just burn hours of my life and I look like an idiot to a seller when I just pull out because of the neighborhood. Haven't made that mistake in a while, but I've made it multiple times, all right? I've also made the mistake, and this is a bonus for you guys just purely because I came to mind, flood zones. Be careful with flood zones when you're buying parks. And we won't get into super in-depth detail on this. This is kind of your bonus. The first thing you should be checking is market data. Make sure to drop in the comments, guys, if you have questions, and I'll get them answered. Excuse me. Make sure to put your name in the comments so I know who I'm talking to. But anyways, avoid flood zones because there's going to be issues with insurance. There's going to be issues with bringing in new homes. There's going to be like real life issues when it does flood. And there's a whole bunch of reasons why you need to be careful with flood zones. But kind of along those same lines, check the market data, then check flood zone, then you spend some more time on it. But before spending any real time on a property, those two things need to be looked at so you don't waste a lot of time. Dang, we got a bunch of questions coming in. This is good. Keep them coming. I'm going to answer them. So those are 3 major mistakes that I'm seeing people making. And whether it's just a waste of time and something that's going to pop up later and you're going to figure it out, or if it's a catastrophic mistake that could potentially cause you to lose millions of dollars or get stuck with a property that nobody else will buy from you. Give an example, due diligence is so crucial because you can get into a deal, buy it, and then figure out what you've bought and realize now you're stuck with it because you got to disclose that to the new buyer and nobody wants it. Like I've got this deal that came to me today, and I've seen this deal for probably about, I don't know, 2 years or so. And the person who brought it to me, great intentions, had done some research on it. And immediately when I saw this park, I went, wait a minute, this was built on a landfill, wasn't it? And yeah, this was, but it's clean. It's got a clean bill of health. It's got the, phase 1 came back clean and all that. I'm like, man, that is such a mistake to buy that property. And it might even be just purely stigma because the tests might come back clean. But look, there's not many people that are going to buy a property that was built on a landfill. And so once you own that thing, you're stuck with it. You're stuck with that for life pretty much. Or until you default, it's going to be very hard to get financing on something like that too. So I'm getting in the weeds on a lot of this. We're getting a bunch of good questions coming in here. So I'm going to start answering these. Just make sure whenever you're doing due diligence that you've got a really good checklist, okay? It should cover your financial, your physical, and your legal due diligence steps. And it should not be like a page long. This should be multiple pages long, super in depth. It should cover both on-site and off-site due diligence work to make sure that you're only buying good investments that are going to end up being profitable for you, okay? One thing I just want to mention is that there's super big money in these deals, but you've got to know how to buy them right or you can lose big money, all right? So just be really careful about it. Make sure that you're studying up. Again, if you want hands-on coaching, if you want super thorough education and someone looking over your shoulder to make sure that you're buying good deals, shoot me a DM with the word learn or go to getrealcashflow.com and learn how I can help you do that. I'd love to work with you. I got a group of people that I'm helping right now buy mobile home parks, and it's pretty exciting. You can actually partner with me as well. All right, so we've got some questions already coming in. Let me start at the top. What's up, Khalid? Good to see you again, Mario. Yeah, thank you. Appreciate that. Good to see you too, buddy. He's like, he's on a bunch of stuff. So good to see you. All right, next one. Take this off. Next question. I'm not sure who this was that asked this because they didn't follow instructions on the Facebook account, but it's okay. Curious, aside from cold calling, do you do anything like Facebook ads or mailers to find deals? Have you successfully used VAs to cold call for you? Okay, good question. So from a marketing standpoint, the 3 places that we have bought the most properties, all right? Number 1, cold calling, direct relationship building with owners. Hands down, it's worked the best. It still works the best. Is it like time consuming and expensive? Yes, but it works, okay? I'm going to answer your second question as a part of this because you asked about VAs, virtual assistants. Here's the thing with VAs on single family versus multifamily or any sort of commercial property. When you're buying single families, and I see a lot of people using VAs and stuff with single families, you're usually working with unsophisticated sellers, right? These are sellers that don't sell property on a day-to-day basis. They don't buy property on a day-to-day basis. They're not they're not very transactional, okay? So you're going to someone that doesn't know or care about the valuation. They just need out on a single family. VAs might work, okay? I do not use VAs for mobile home parks or anything commercial. And the reason is because it's hard to take them seriously, especially if there's any sort of accent. That's not me being racist, okay? It's me just being real. If you're out making phone calls and your English is not good enough to where people are going to understand you and you don't know American culture, you're going to have trouble with that, okay? It's just fact. Sellers are going to instantly know it, and they're going to hang up on your VA. They're going to have to go through way more calling to get any leads. And so I guess my angle on that is if you're going to use a VA, use somebody that has very good English, and more importantly than even their their English, equally as important as their English and their accent. It's make sure they know American culture, okay? Because if they call them and the seller starts talking to them and they don't understand what the person's talking about because they just don't understand our culture, it's going to show through so fast and they're going to be gone. Typically, when I get a call from a VA, I instantly know it and I'm respectful to them, but I let them go. I usually have a little bit of fun with them. I'll go, oh, which park? Because they all call and say, I'm calling you about your mobile home park. Cool, which one? It's like, and they don't know how to answer it, and they get totally thrown off. And I instantly call, hey, thanks for calling, not interested in selling, I let them go. But if you call me and you're a legit person that knows the business, I'm probably having a conversation with you for 5 to 15 minutes, even though I'm not going to sell something to you. I'm still going to talk to you and build that relationship with you. So I would just be very cautious about using VAs. Other strategies that have got me deals are mailers, okay? I've also done some driving for dollars where I drove into a park, found the owner, and done that. But it's very, driving for dollars and some of those more labor-intense strategies, they work, but it takes a lot of time. I mean, think about driving to a bunch of parks and spending time. You can do it, and your close ratio might be fairly good, but it's very time-consuming. So hope that answers your question. There's a bunch of different ways to market, but the first way, cold calling. Second way is through wholesalers. I bought a bunch of contracts off of people. And then third is through brokers, but brokers that aren't focused on mobile home parks, okay? Let's get to the next question. That was a good one. Thank you, whoever asked that. When I saw really rundown or old homes, I'm afraid there will be so much maintenance associated with the park on other things. So I automatically turn it down. Any insight about what condition of the park that I should be aware of? Okay, so here's the deal. If you're buying a park that's all rental homes and they're in rough shape, you're in a lot of trouble. And rough shape to you and I might be a little bit different than what reality is, okay? Just because a home is older doesn't mean that it's necessarily a bad home. Just because it's an older metal on metal and it needs a paint job doesn't mean that it's in bad condition, okay? But what I would really be looking at if I was going into a park is, yeah, I do look at the condition of the homes because it tells me how the tenants take care of their homes, okay? Especially if it's a tenant-owned home community, that matters. It also reflects on how management has been handling things. If homes are looking really rough, there's a lot of trash all over the place, it's often a management problem more than anything. Rules haven't been enforced or made clear of what they are, and that's something that can be resolved, all right? I do look at signage. I look at roads. I'm going to look for common area issues, if the office or clubhouse or pool area, if that's in really rough shape. It tells me that there's a lot of deferred maintenance. But what I want you to recognize is that with thorough due diligence, that actually becomes an opportunity. All right, you shouldn't be scared of a property because there's deferred maintenance. It's kind of like when you buy a home to flip. Buying a home with a lot of work usually creates a lot of opportunity because there becomes a bigger spread. The seller's usually more motivated. And so with good due diligence and an understanding of how to buy properties like that, that's actually a good thing, okay? Don't get me wrong, I'll take a really good deal on a super clean property any day, but I would say the majority of awesome deals have come from properties that had good amount of deferred maintenance. So don't let that scare you. I believe that was the entirety of that question. All right, we got another one. Keep them coming, guys. These are really good. Hang on. What is the minimum? Okay, here. What is the minimum household income needed for a lot rent model? 45K. So I wouldn't go really below 40. I mean, if there's some unique situations that I do want to touch on, but my threshold's like 40 to 45, and I'm looking at multiple metrics, not just that. But there are certain areas, like I'm looking at a deal right now that happens to be in Florida. And there's a lot of retirees in Florida and a lot of snowbirds. And there's a lot of retirees specifically in the area that I'm looking. So they don't have a lot of earned income, but they've got cash, right? They own their home free and clear and all of that. So you need to be really careful when you start looking at like occupancy rates and median household income, things like that, and make sure that the area is either not like a very high vacation spot or a very high retiree location, because that will throw off those numbers a bit. But generally 40,000 is I want to be above 40,000 for median household income. Not a hard and fast rule, but it's something that is important to come close to. Okay. If everything else hits really hard and is really strong, and it just for some reason shows that lower median household income, holy crap, we got a bunch of questions coming in. I'll try and catch up here. In that case, then I'm going to look at things a little bit closer in my due diligence process to try and figure out why, and just make sure that there's not something that I'm missing. All right, next question. So is Florida still a good market since the insurance was increased after Ian? Great question. So insurance has always been a problem in Florida, more so in the last probably 2 to 3 years. Insurance prices have really went up. We had some properties that went from randomly, we had property that went from $20,000 a year in insurance, total insurance cost for the year, up to $100,000. And I'm not kidding you. They sent us a notice and said that they were dropping us, and we went and got a new quote, and it came in at $100,000 overnight. Of course, we shopped it. Of course, we figured out a way around that. We ended up getting it for about $35,000, but still, that's a big jump for insurance. I mean, thankfully, it was a great property, stabilized, running well, tons of cash flow. But yes, in Florida, you do need to take into consideration insurance costs. Do not look at your seller's finances. Like we talked about, don't look at their financials and go, oh, well, just because they only pay $1,800 or $1,300 a year in insurance, that's what mine is going to be. All they've probably got is, you know, $1 million general liability policy, and that's it. You need to have much better insurance than that. But great question. I love Florida. I'm buying in Florida. I bought in Florida last year. I'm buying stuff in Florida now. I actually own parks here and have owned parks here since the start. But I own in other states too. But I do love Florida for many different reasons. You just got to understand it. Okay. All right. Next question. These are super good. All right, Nathan, what's up, dude? All right. So Nathan's actually one of our coaching clients, and he's on the rise. All right. What is the difference in expense cost for city utilities versus well, water, and septic or other utilities? All right. So this is kind of a trick question. I should give you a trick answer. So the answer is you should not be paying the utilities. Okay. Water, sewer, electric, those should not be expenses that you are paying. There are maybe a few markets that is just the norm, and you got to pay attention to that. But generally speaking, the first thing that you want to do before you even raise rents would be to bill back utilities in order to get that off your plate and get rid of the fluctuation in cost. Think about it. If somebody decides to run their toilet and run their sink at the same time, and you get several $1,000s worth of a water bill, and you got to figure out where that's coming from, that's a nightmare. Okay. Sure, you can meter it and to track who's overusing, but if you're going to meter it, you might as well bill back. So here's the thing. You should be billing back water, sewer, electric should be billed directly, unless you got master meter electric, and then you got some real issues you got to work through. But we typically bill back trash as well. And we do all of that before we ever raise rents typically, because we want to get those expenses off our P&L. So to answer your question, well water is going to cost you, depending on the size of the park, how many wells you have, all of that. This is kind of a general question that you're asking. So it's going to cost a lot more for city. I mean, just simply said, if you had city water and you had a well, your city water is going to be tens of thousands of dollars. Your well is probably going to cost you thousands of dollars, or, a few $1,000s a year. But you do need to have somebody testing. You've got to do chlorination. You've got to submit for for lab testing and other things. There's a lot of reporting. You got to deal with the environmental departments. There's a lot involved in it. Septic, you're going to have very little until they start to fail or have issues. Your maintenance costs on that's going to be very, very minimal. Wastewater treatment plants, not super horrible on maintenance, but when they go bad, they go really bad and they're super expensive to replace. Lagoons, you don't want to mess with them. They're pretty low maintenance, but when they go bad or when the health department tells you can't have it, then you got real problems as well. City's always going to be best. It's the most costly, but you are going to want to build that back. So super good question, Nathan. All right, next question, landfill. Keep them coming, guys. I got to catch up. Landfill, flood zone, anything else that could be an absolute deal breaker? Oh, there's a ton of things that could be a deal breaker. Yeah, there's a bunch of things that can kill a deal. We don't have time to go over all of them on this call, but I mean, yeah, you could be, flood zone is going to be big, landfill, huge problem. You know, neighborhood in general is a fast pass for me. And in the beginning, when I started buying parks, I was a lot more like lenient on the neighborhood because I'm like, oh, it's affordable housing. I want to be in an affordable neighborhood. But I realized on specifically one deal that that's not the case, and you do not want to be in those type of neighborhoods. And so I would say neighborhood is probably one of my biggest fast passes when I look at a deal. Size also is important. And what I mean by that is you need to know your minimum threshold on how large or small basically how small you'll go. And a lot of people go, well, I'll go as small as, possible because that's the safer route. It's actually not. It's a much higher risk investment buying a 5 to 10 space park than buying a 100 space park. And what do you mean? How is that possible? It's so much more expensive. So much more could go wrong. Well, you're also diversified over so many more tenants paying you, and you've got much better options on financing, way more buyers for those. So long story short, I'm just thinking off the top of my head, some other deal killers. I would say if I've got this is a good one. A lot of people don't know this, and a lot of owners make this mistake. When I go look at a park and there's one owner that owns a bunch of the homes and it's not the park, that's a big problem. Okay. So if I look at this park and I see the rent roll and it's 50 space park, 100 space park, and there's 10, 15, 20 people or 20 homes that have the same last name on the rent roll, major red flag. What that means is that the owners sold homes or given homes to somebody to own as rentals in their community, and now they got you. Okay, they got you because if you want to raise your rents or you want to implement any new rules and they don't want to follow them, all they got to do is say, well, I'm not paying rent next month, and they got you because they're going to have a major impact on your income. So that's another one that's killed a couple of deals. I would say a lot of surprises. You get out on a property and you figure out that the owner didn't tell you that there's some major expenses that are going to need to be incurred, and you can't come to terms on fixing it. So somebody said, hey, everyone, but Nathan, what'd you say here? Coaching with Mario is worth it, guys. Highly recommend y'all look into it if you are looking at buying mobile home parks. Thank you, Nathan. Appreciate that. I will pay you later for that. No, seriously though, I appreciate the plug. All right. We've got Dave Schneider, 3x monthly rent. Not sure what you meant by that. 3 times monthly rent. I think he's talking about what's the qualifier. A qualifier for a tenant moving into your community, they should be earning 3 times what their total cost is. If it's lot rent and they're buying it cash, they're thank you guys. All these comments are like cool emojis coming in. Yeah, your tenants should have a 3 times the rent so that you know that they can afford it. If they're buying the home out with financing, it should be lot rent and the mortgage combined times 3 is what their income should be minimum. Dang, Nathan's rocking it tonight. He's got a bunch of stuff. If you use 40% expense ratio with city utilities, what ratio do you use for well and septic or other utilities? So if you are going to not bill back the cost of the well or the septic or the sewer maintenance if it's private, yeah, you're gonna have a little bit higher expense ratio. Keep in mind, expense ratios are really for like back of the napkin calculations. In the real world, when you model it out or when you actually own it, those expense ratios might be slightly different than a 40 or a 42 or 38% expense ratio. So those are just rules of thumb. Don't buy something based on a back of the napkin calculation. Okay, you got to know how to model it out and understand the big picture on how these things run and what it's going to look like over multiple years. But to answer your question, yeah, I mean, it's probably going to be a few $1,000s more a year on a well. If you eat that cost, we bill it back. So we just take whatever that monthly service fee is from the professional that comes in and maintains the well. We divide it up equally and pass that on like a water bill to the tenants. Think about it. If you don't have like a large water bill and you just don't bill them back for things, $0 for water or $0 for sewer if it's private, having them pay $5, dividing up that cost, as long as the state allows it, okay, I'd do that. Again, you're taking that cost, which is something that they're using, and letting them pay for that. So that's what we do. Good question. Getting a lot of emojis coming in. All right, got another one here. Keep them coming, guys. We got a little bit more time. This is good stuff. Frank said for an RV park, take the past 3 years of income and average it out to value it. Is that how you look at RV parks? All right, so RV parks are looked at completely different, especially if they're more of like a transient RV. There's multiple types of RV parks. It's not just one. You got campgrounds, you got RV communities, you got RV parks, you've got multiple different types of RV properties. And so it's going to depend on the type, but I think what you're asking is if it's an RV park where people are transient, they're coming in for the night or they're coming in for the weekend, or it's like a campground, something like that. Yeah, you're not going to look at it the same way, because in a mobile home park, the owners own their homes and it's a pretty predictable income, right? Because the mobile homes aren't moving anywhere. But when you've got somebody coming in and out day by day, yeah, you need to look at it more like you're buying a business, because that's really what you're buying. So you would go and look at past 3 years minimum historical P&Ls, and there's other things that you want to look at as well, but that's going to be how you value it, correct? You're not going to be doing it, it's not going to be as predictable. And look, I see a lot of people getting into RV parks, and shoot, I own 2 parks that have RV components. One's a full-time, long-term RV park. The other one is a mobile home / RV park, and they do run a little bit different, okay? But I'm not dissing them, but you got to understand that a transient RV park where people can pull in and out by the day, it's much more risky. So don't be paying the same cap rates or the same valuations for an RV park, a transient RV park, as a mobile home park. You're taking on more risk for the same price. So just something to take into consideration. I've got nothing wrong with RV parks. I like them. You just got to know what you're doing. Don't value RV parks like you do a mobile home park. Good question, whoever that was. All right. Here's another one. Keep them coming in, guys. Can you touch on what's your coaching program include, the length and the price if possible? Just for the sake of time, and I don't want to turn this into like a pitch fest or anything, just go to getrealcashflow.com or shoot me a DM with the word learn, and I'll send you a link. You'll have the information, everything that you're asking for. It's not like a bunch of fluff or anything. I just don't want to turn this into a pitch fest, but appreciate you asking. Okay. If it's a mobile home RV park, would that component, whether it's transient or permanent, what expense ratio are you using on the RV park? It's 50. Okay, so somebody did dollar signs. So the the answer to that question is typically in RV parks, depending on the amenities, okay? And depending on how transient it is and all your setup, but especially amenities and programs and staffing is gonna have a big variable on RV parks. And I don't want to pretend like I'm an expert in RV parks. Just like I own self-storage. I don't claim to be a self-storage expert. Mobile home parks, different story. So I'll give you kind of a high level on the RV parks, but I don't want you to go take this information and try and go buy a RV park with it. Typically your RV park expense is going to be around 50%. Could be a little bit higher, especially if you've got like a lot of programs, you've got a little store going on there. I mean, I've seen some that have delivery services where they deliver wood to your door. I mean, some pretty cool stuff, but also expensive pools, you know, a lot of functions going on, and that takes a lot more people and staff. So generally speaking, 50% expense ratio is going to be kind of a back of the napkin, but they can go higher. All right, here's another one. What expense ratio do you apply to the half of the park that's RV? So good question. It's a transient RV park. I'm not a fan of, to be honest. I prefer long-term stay RV parks. They're called RV communities, and people basically live there in their RVs. But I would basically break it out. I would break out the RV portion to 50%. And I would break out the home portion to whatever expense ratio you expect on that, okay? I don't know who's actually messaging this because they didn't put their name, but thank you. You're an expert to me. And we've got, since you own both storage and mobile home parks, which one do you think is a better investment? Pros and cons between these two. Dang, you guys are on fire tonight. This is good stuff. Here's the deal. I own both. I don't claim to be an expert in storage. I own them and they've done very, very well for me, but I don't own a management company that operates them. I haven't built out storage in scale, okay? I have a few and I love them. I'm buying one right now, actually in Florida. If you're an accredited investor and you want to own some self-storage with me, shoot me a DM or something, and I'll talk to you about it. Got to be accredited, but we're raising capital for a storage deal in Florida right now. That was natural. That was not set. Anyways, so storage, I would say, is good because you've got variable rates, meaning your rates will change by the day based on your occupancy. It's very good for keeping up with inflation. Your rents can change monthly. And you're able to fill units very quickly based on just the ability to advertise and somebody move their stuff in, okay? The negatives on storage is people can move out relatively quick because they are month-to-month leases. Storage, you don't have kind of the same moat around the industry that you do in mobile home parks. Good luck building mobile home parks. You know, for the most part, it's a challenge, and financially it doesn't make a whole lot of sense. Storage, it does. So you got to buy in markets that don't have high risk for new development because it's immediate competition. So those are kind of a couple things that I think about with storage. Also, if you're buying in markets with very strong population, you're going to do really well in storage. If population is decreasing, I'd be concerned about that. That's why really I only buy storage in Florida and Texas. At least that's the only places I bought it to this point because I'm super confident in population growth in those markets. And so that's why I like storage. I would say for mobile home parks, I like the stability of them. I like the predictability of them. I like the fact the lowest cost provider housing, especially non-subsidized housing. You're not worried about other people moving in, developing a park across the street. And they're slightly less management intense than, let's say, apartments or some other more active property types. So I could go on both of these properties for an hour on why I like both of them. But I guess the negative mobile home parks is you are dealing with residential tenants. These tenants are, consumers. There's certain laws that protect those tenants, and not that I, want to take advantage of people or anything like that, but it can create extra work for a property manager to have to deal with residential tenants. And I think that they're not sexy. You know what I mean? Nobody's going and bragging about mobile parks. I've never went to like a party or some sort of event and be like, yeah, I invest in mobile home parks with people who aren't in real estate. They're all like, oh, okay, whatever. Like they don't even really know what I'm talking about, let alone care. Where if I mention storage, it's like, oh, I love storage. So it's weird. Like, yeah, I invest in mobile home parks and storage to someone who's not in real estate, and instantly they're like, oh, storage is awesome. I've heard it's a cash cow. So it's just, anyways, you guys get the point. There's positives and negatives to both. And I'm not like one of those type of people that is super, what's the word? I'm not cultish. You know what I mean? Like when I look at real estate, stocks, fixed income investments, crypto, I mean, when I look at any of these investments, businesses, I don't go, oh, that one's a scam, or that one sucks, or that one's great, that one's the best. I understand the difference between them, and I understand the positives and negatives, and I understand that some are better for certain people than others. But what I see a lot is real estate guys pounding their chest, oh yeah, crypto, you guys suck, or stocks, you guys suck. And then they realize, they forget that, yeah, well, real estate market is going to crash too. So every market is cyclical. The timing is just different. So what's going to happen is when the stock market rallies and real estate is lagging to get caught up, the stock guys are going to be going, oh, real estate, you guys are losers. Look at what you guys invested. You should have been buying stocks the whole time. So I'm not like that. Same with crypto. Everybody says crypto. I understand crypto enough and own enough of it to say, hey, I get it. I'm not a big crypto guy, but I understand it. And I understand the benefits and the risks with it. So not pitching any investments tonight, but you guys get the point. They said, what is this? Because I'm having a hard time to decide. Okay, so that must have been a follow-up. Guys, if you got any other questions, drop them in the chat because we're going to be ending soon, but I want to make sure that I got one more question here to answer. Oh, we got another one that just came in. But yeah, I mean, it's hard to decide, but you don't have to decide. You can buy both. Like, again, you don't have to be cultish about things. You can choose to operate certain investments and then be passive in others. You can be passive in all. You can be active in all. Like for me, I buy mobile home parks. I own a management company that manages mobile home parks for myself and for other park owners. I have all the different companies that support mobile home parks, a dealership, a mobile home title company, all these different businesses. So I'm very active in the business of mobile home parks as well. Where storage, I buy self-storage and I solely handle that asset management role, okay? The ownership responsibilities. I either hire third-party management companies for facilities that are 50,000 or larger square feet, or I partner with active operating partners on buildings that are smaller than 50,000 square feet, and that with partners that are used to operating the smaller self-storage. So I don't operate self-storage, I own it, I buy it, but I operate mobile home parks, and it's totally fine to do that, okay? All right, here's a long question. I'm looking at a smaller park with a high number of park-owned homes with seller carry offered. Does the seller carry offset a calculated value less than asking price? Excuse me, darn root beer's getting me. Does the seller carry offset a calculated value less than asking price? In this case, the calculated value is $40,000 less than asking price. Dave. All right, so I think I know what you're asking. Okay, I think what you're asking is if it's seller financed. Are you asking about the home, or are you asking about the seller financing on the homes, or are you asking about the park being seller financed? Let me read that one more time. Sorry, guys. Sometimes these questions I'm having a hard time getting them. I'm looking at a smaller park with a high number of park-owned homes with seller carry offered. Okay, so that's probably for the park. Does the seller carry offset a calculated value less than asking price? In this case, the calculated value is $40,000 less than asking price. Interesting. So usually when a seller, and you can correct me if I'm going down the wrong path here, Dave, but usually when a seller is selling me a park, if anything, they're trying to put a higher value on the park because they're offering seller financing. They're saying, well, I need this price, but I'll carry the paper, so you should pay me too much for this property. It's usually what I get. And I think what you're saying is that you're actually getting it for less than market value and the seller's carrying paper. That's a good thing. I mean, here's the deal. I don't depend on seller financing. I like seller financing if the terms are competitive with what I can get or better than a bank, okay? So I'm not gonna go and buy a deal and pay way more than the property is gonna be worth by the time I need to exit it, just because the seller carried paper. I'm really looking at the same metrics, cash on cash return, internal rate of return, things like that. I'm looking at those metrics to see if it's a good deal. I'll typically offer them to give me seller financing to help them, not to help me. I can buy the park cash. I'm bankable if I want to use bank financing. The properties will support financing. It's their property and their needs are why I typically will allow a seller to carry the paper on. Okay, so I don't know if I answered your question because I'm not quite sure what you're asking me. So maybe I'm just running slow tonight mentally, or you might want to do a follow-up on that just so I make sure I get what you're asking. If to partner with you, do you have buybacks? Can share those? Yeah. So if you want to partner with me, it's basically think about 50 or more occupied lots. We got more questions coming in, so keep them coming. Really, 50 or more occupied lots is where I start getting excited. If it's like 40 to 45, but in a strong market with high lot rents and things like that, or I own a park in that same market or near it, then I'm interested, okay? So 50 or more occupied lots. I don't want to be out in the boonies, so I need to be near a metro. Typically 50,000 or larger metro is kind of what I'm looking for. And ideally, public utilities. I will buy private, but it's got to be a great deal for that. And yeah, so I mean, really bring me anything that's 40, 50 occupied. Keyword is occupied lots or more. You should be hitting me up about that. I'd love to look at it with you. What is this? Do the questions. The seller is asking more than the value. Okay, got it. So basically, that's kind of what I was thinking you were saying, Dave, is that he's asking more and saying, hey, because I'm giving you seller financing, you should pay me more. Now, does that mean you couldn't pay a little bit more? Sure, you could. Probably if you can get the interest rate down, if you can get the amortization a little bit longer, if you can maybe get a little bit of interest only in there, you can probably get the same cash flow. But here's the deal. Don't go get a 10-year loan, 100% interest only at lower interest rates and all this stuff, and then pay double because you can make it cash flow. You're going to have a problem later when you go to sell that property, especially if you're doing interest only the whole time. Just be really conservative. Just recognize that seller financing can be a great tool, but it doesn't mean you just super overpay for stuff because the seller's carrying paper. Really think about this. Seller financing just means that you don't have a bank double checking and looking over your shoulder. And I'm not saying that's a bad thing. It's just, it's easier to finance, sure. You don't have somebody else double checking you and making you provide reports or financials every year or anything like that. So there are benefits, but I wouldn't just find deals that have seller financing. I think that's a big mistake. You're probably missing out on a lot of deals too. Cool. All right, we got another one. Cooper, what's the general script when making cold calls? Is there a minimum number of lots you consider worth going after? All right, so I'm not going to go through a whole script on this. This is kind of I'm getting more questions than I can keep up with, but the key is to not unscripted, to be your genuine self, and to practice and have a written out script so you know what you're going to talk about. If you just call somebody up and don't really know what you're going to say and how to handle that conversation, you're going to suck and they're going to know it. But you can be following a script word for word. It's funny, like when I work with my acquisition guys and they listen to me do my calling, because like we'll do training and stuff like that. My calling is so natural and so not professional and so like, I don't want to say genuine, but it's just legit. And I don't mean to say it in like a braggadocious way. It's just, I'm just being myself with that person. And it works so much better than if you're like dropping your company name and doing all that. And then minimum number, I mean, realistically, for me, 50 plus occupied lots is where it gets interesting to me, because I think scale, I think payroll, I think costs, things like that. You know, your expenses will be much more painful buying a 20 or a 10 space park than a 50 or 100 space park. You might go, well, I don't have all the money to buy a 100 space park. You don't need all the money. You just need to know how to find the people with the money, okay? And that's honestly the way to buy the right type of properties, is to know where to get the money to buy those properties. But to answer your question, 30 or less lots gets real skittish to me. I mean, you have one water break that costs several $1,000s. Let's say you get a water break and you're in Minnesota and you got 6 foot, 7 foot deep lines. You're paying $8,000, $6,000, sometimes more to find that leak, if you can find it quickly and get it repaired, because you got to dig so deep, especially if it's in the winter or something. So, I mean, that can just wipe out returns if you're buying really small stuff. It's not like single families. Don't go small. Go big, go as big as you feel comfortable going. So great questions, Cooper. All right. Thanks, Mario. You're providing so much value. Thanks, Ashley. I appreciate it. How are the park on homes being valued? How are the park, I think it means how are the park-owned homes being valued? Shell value. We talked about that earlier. That was one of the 3 key mistakes that that we talked about. You need to be valuing those homes based on what you could sell them for quickly. And you got to take into consideration all the expenses that go into that. Do not apply a cap rate to the home rent. All right. Disregard the last thing that was a comment on Dave's last question. Okay, I got you. I would ask a really good term for seller, such as low interest rate, lower down payment, and 10-year balloon payment. Yep, agreed. I mean, you're obviously going to ask for the best terms possible. You're going to need to be realistic, but keep in mind, if somebody's in a really bad spot and they don't even need the payments, they just need out for certain reason, you might be able to work a sweet deal where there's no principal or interest payments for a period of time. Like, I got a deal that we bought in Texas just end of November, it was like 20th of November or something. And I ended up working out some interest only with him. And then he ended up coming back and negotiated to where I got like 4 months mortgage payments. And I'm like, sweet. So I don't even have interest payments. I don't have principal, nothing for like 4 months. First year of ownership, that's huge. Okay. All right, we got another one. It says, also get ready for sell it after the balloon if you end up paying much higher than the market value. That's kind of what I was saying. I'm not sure who's posting that, but yeah, I mean, if you're overpaying for stuff because you got seller financing and that loan balloons, you really got to understand your amortization schedule and to market right to get out of that comfortably and unscathed. So just be really careful. Don't overpay for stuff, guys. There's so many deals coming up this year. I'm telling you, we've got a lot of opportunity in mobile home park investing and other real estate type that you need to be taking advantage of it. You need to be in position. Don't wait till the market starts to get crazy and be like, okay, now I need to go learn how to buy this thing, where you're already behind the 8 ball. You're already chasing all the people that have been out building relationships with owners for the last several months. You want to learn now and then go start marketing now, build the relationship. So as the market goes south, more sellers need to sell for different reasons. A lot of it will be debt related reasons to sell. That's where the opportunity comes in. So from there, guys, this has been awesome. Make sure if you want to learn how to buy these parks, DM me the word learn or go to getrealcashflow.com. This has been tons of fun. And we do this the last Thursday of every month, same time, same place, 8 o'clock p.m. Eastern Standard Time. It's been fun, guys. Catch you later.